In this session, we're going to have a look at the other financial statement that we must be able to prepare when we're looking at group accounts. Now, we saw in previous sessions that we've done the consolidated statement of financial position, but also we had some various consolidation adjustments to go along with that. If you remember, we had intercompany trading, PUP adjustments, fair value adjustments, and we may also be asked to calculate the cost of the investment. Now, usually they're tested in isolation in the exam, rather than all together in a big question that you saw towards the start of this chapter. So in this chapter then, we're going to have a look at the other financial statement that we'd prepare for the group, and that is the consolidated statement of comprehensive income, or income statement if you like. So in your notes then, let's have a look at the pro forma consolidated income statement. And can you see that it looks ever so slightly different to what you normally see as a limited company statement of comprehensive income? Can you see then that we still have the normal headings? Revenue, your sales, cost of sales, gross profit, distribution, admin costs, finance costs, profit before tax, tax, and profit for the year. That all looks the same. But rather than having one column showing figures, we've now got four. A column for the parent, a column for the subsidiary, a column for the consolidation adjustments, and then the group column. So effectively, these first three columns are essentially workings in order to get to the group consolidated income in the year. So it's just a case of you'll be given the parent and the subsidiary's statement of comprehensive income for the year, and all you do is take all their income, parent and sub, and add them together. Okay, so for the parent, we take all of the parent's revenue and expenses on a line-by-line basis. And the same goes with the subsidiary. Regardless of the percentage holding, we always take 100% of the subsidiary's revenue and expenses and add them to the parent's on a line-by-line basis. Okay, so if we start off then with revenue, parent plus sub, copy that from the question. But then what we have is a figure here in minus, and that's because of some intercompany sales. Now, if the parent sells to the subsidiary in the post-acquisition portion of the year, so let's say we held the subsidiary for the year, and in that year we sold $1 million worth of goods to the subsidiary, well, included in the parent's revenue will be $1 million that they recognised as income due from the subsidiary. But from the group's perspective, that is not true external sales revenue. $1 million of that is essentially sales from transferring goods from one hand to the other, okay, from the left to the right hand. So as such, we need to cancel them out, and we need to eliminate intercompany sales at that point. Okay, so if it's included in the parent's or the subsidiary's revenue, whether parent sells to sub or sub sells to parent, we're going to minus any intercompany sales in the post-acquisition portion of the year. Okay, from the group, the single entity perspective, it doesn't exist. So we must cancel it out on consolidation. So we take parent plus sub minus intercompany, and that's going to equal group sales revenue. We then look at cost of sales, parent plus sub. Again, copied from the question. Remember to take all of the subsidiary's cost of sales, regardless of the percentage holding. Don't take 80% of it, always take the full amount. Notice then in the adjustments column, we have a positive figure. Now, if the parent sells to a subsidiary in the year, remember the parent would recognise $1 million worth of intercompany sales, which we need to eliminate. But from the subsidiary's perspective, they would recognise a cost to buy goods, a cost of a sale, and that would have been $1 million. One company's sale is another company's cost of sale. So included in the subsidiary's cost of sales is $1 million, a purchase from the parent. which from the single entity perspective doesn't exist. Now, we've overcharged cost of sales. We need to remove it. Cost of sales is a negative figure. So to reduce down that negative, we need to put a positive figure in to represent intercompany purchases. And notice in the adjustments column, they'll both be for the same amount. Reduce sales by 1 million, reduce cost of sales by 1 million. Yeah, they'll be the same figure. So they'll actually cancel each other out. But when you add across to give group cost of sales, the group cost of sales will be lower because we've eliminated those intercompany purchases. Now, we do have another adjustment that affects cost of sales, and that is the PUP adjustment, the provision for unrealised profit adjustment. If you remember in earlier sessions, we said that a PUP adjustment is going to artificially increase the selling company's profits because all we're doing is selling goods to another company within the group at a profit. All you're doing is transferring goods at a profit between the same entity in reality. So we need to strip out the unrealised profit from the selling company's retained earnings, if you remember. Retained earnings are your accumulated profits. So if there's any PUP arising in the current year, that will also affect the current year's profits. Because remember, current year's profits get added to retained earnings. So, if the parent sells goods to the sub, the parent's profit is too high. We reduce that down by adding it to the parent's cost of sales. And notice that's a negative figure because it will reduce profit. If the sub sells to the parent, well then it's the subsidiary that made the unrealised profit. We need to take it out when calculating the subsidiary's profit for the year. So you must note the direction of the sale. That's very important. Okay. Just like we talked about when we did provision for unrealised profit in the context of the CSFP in earlier sessions. So, what we do then is we say parent cost of sales plus subsidiary cost of sales minus intercompany purchases plus PUP. So parent cost of sales plus subsidiary cost of sales plus PUP minus the intercompany purchases will give you the group cost of sales for the year. So PUP gets added to cost of sales usually. So that's what we're going to do. All right, so moving on then at that point, we'll then have parent cost gross profit added down, subsidiary gross profit added down, and then that'll equal the group gross profit added down. Now what you're going to do is add every line of income and expenses. You are not going to take the parent and the subsidiary's gross profit given to you in the question. This is a case of just adding down and finding the new gross profit after these various adjustments that we've made. Okay, so moving on then, we have other income, parent plus sub equals group. Distribution costs, parent plus sub equals group distribution costs. Same with admin expenses. And the same with finance costs, parent plus sub. Okay? We get profit before tax by adding down for each column. We'll then have tax. Parent plus sub equals group tax expense. And then profit for the year, or your net profit, parent add down, subsidiary add down, and the same for the group as well. Okay, so we need to cast down the parent, the sub, and the group column. The adjustments column would always be 0 because of the intercompany sales that we've contraed out. Now then, what we then have to do is add on an extra bit. Okay, this is pretty usual to what you've seen in an income statement or statement of comprehensive income previously, but now we've got 4 columns rather than 1. What we then have to do is do the profit split. And say who owns that profit, who is entitled to the group profit in the year. Now, we know there's going to be the shareholders of the parent that are going to want profit and also the non-controlling interest. Now, the non-controlling interest, remember we abbreviate to NCI, are going to want their share of the subsidiary's profit in the year. So if the NCI has a 20% share in the subsidiary, they're going to want 20% of the subsidiary's profit for the year. Not the group profit of the year. Remember, the NCI don't own the group. They own 20% of the sub, not 20% of parent and sub. Okay? So the NCI are going to get their share of the subsidiary's profit for the year, not the group. That's very important. Please remember that and bear that in mind. Now, we know that group profit will be the total. So that's going to come down here to the total. Now, if we know group profit is, let's say, I don't know, $1 million, and we know that $200,000 is going to the NCI because we did our calculation, well, then the other $800,000 must be attributable to the shareholders of the parent. In other words, all of the parent's profit plus 80% of the subsidiary's profit. But it's easier just to remember that as a balancing figure. You know the group gross profit for the year. You know how much to give to the NCI, 20% of the subsidiary's profit. Well, everything left over must be going to the equity holders of the parent. In other words, the parent shareholders. So we split out profit at the end. We do not split it out during the consolidation schedule. And we must remember to add this profit split at the bottom of the consolidated statement of comprehensive income. The examiner could say to you, here's the group profit, here's the subsidiary profit, do a PUP adjustment, let's say. Now calculate the profit attributable to the NCI. And that could be a typical 2-mark question to do with group accounting in terms of the statement of comprehensive income. So, a lot of the complexities in group accounting we've already seen. PUP adjustments, the fact that we treat the entity as one, so any intercompany transactions must always be eliminated. We only want to show external revenue and costs outside of the group. So, in our next session then, we'll revisit the idea of intercompany trading and PUP adjustments, but also other things we may have to consider specific to the consolidated statement of comprehensive income.